Hello and welcome back, my Pixel peeps. Nicole Payne, CMA, here as always to drop some accounting truth bombs. And today is part 4 of our 4-part mini-series on reading financial statements. If you haven't had a chance, go back and watch the first 3 parts. They are very enlightening about financials, and I'm sure you'll get some quality information out of them. Today, we are going to be talking about the statement of cash flows or cash flow statement, depending on what your accounting software might call it. We use those interchangeably in the industry. So I'm going to go ahead and get my screen shared with you so that we can jump in here and look. As always, I'm going to use my disclaimer. This Craig's Design and Landscaping Services is a sample company provided by QuickBooks. It is not a client of Pixel. None of the data in here has anything to do with any of the Pixel clients. It's completely fictitious. So that's my disclaimer. And with that, we're going to jump right in to our reports and into the statement of cash flows. Again, the default with QuickBooks, it's going to default to year to date. I just want to do this year to last month. So we're going to run this based on, because the other reports that we've looked at was through June of 2021. So I want to do this one through June of 2021 as well. Okay, so the thing about the statement of cash flows is we typically will get the question from clients, well, my income statement says I've earned X number of dollars, but my bank account doesn't reflect that. There's not that much money in my bank account. Where did that money go? This statement of cash flows tells you where that money went. So it takes your income statement and it takes your balance sheet, marries the two together, and you can actually see why your cash has changed when your income statement may not have. So reading this, we're going to look through kind of line by line of this income statement or the statement of cash flows. The biggest thing that we see here is that there was net income for the year to date, but they have accounts receivable. And what this means is they have income that's reported on the income statement, but they haven't actually collected that cash to the tune of $5,200, $5,300. So that's money that they haven't collected, but it's showing as income on their profit and loss statement. They've also spent some money on additional inventory that isn't being reflected on the income statement because it's not reflected on the income statement until they've actually sold that inventory. Accounts payable, they have some expenses that they have accrued, that they've incurred, but they're bills that haven't been paid yet. So this is actually a positive for their cash flow. They have some money that they've charged to a credit card. So those are expenses that they've paid, but they haven't actually paid the credit card. So that's also a positive to their credit card or to their cash flow. They have some taxes that they owe that are showing on the income statement, but they haven't left the bank yet. So again, positive for their cash flow. But then they have this loan. They've actually paid down some of the principal on their loan. The principal of the loan doesn't get reflected on the income statement at all, ever. Only the interest does. But they've paid down the principal, so that's money that's left the bank that's not on the income statement. So all in all, they have $2,700 that has left their bank but hasn't actually been reflected on their income statement. Then down here, they also have this financing activities where they have paid down this note payable. This is a long-term debt that they're going to pay over many years, and they've paid down a portion of it, a pretty good portion of it. So again, more money that has left their bank but isn't on the income statement. And then the big thing you see here is that the owner has invested some money. They've invested quite a bit of money in order to cover these costs that are coming out of the bank account when there's not enough income to get them paid. So then here at the bottom, you see the total change for the period, the money that they had at the beginning of the year, and what they have in the bank now. And that is the total of these two things. So the total change plus what they had at the beginning equals what they have now. So that is our deep dive into the statement of cash flows. Unfortunately, with this, it doesn't show us, there is a third category that would sometimes show up, and that's what's called investing activities. So this is times when you're actually buying big assets like vehicles, equipment, furniture, things that are going to be used for the company over many years and would typically have to be depreciated for tax purposes. Those go on the balance sheet. They may or may not be money that's left your bank, depending on how you pay for them. But they don't affect your income statement. And so that's another area that would normally be in here. This particular company doesn't have a whole lot of assets. So again, because it's fictitious and the person who created this file didn't create any assets for the company. So if you have questions about how to read your statement of cash flows, shoot me an email, give me a call, or drop it in the comments below. Like, comment, subscribe. We would love to hear from you, and we appreciate your support. And until next time, take care, everybody.